thanks for joining me on my market report. My name is Mike, and my market report is on mortgage rates. We discuss on a daily basis what impacts mortgage rates, whether it might come something from like the economic calendar or a combination of that with headline news or geopolitical. But sometimes it gets even more confusing out there when you're watching the interest rates and see good news being introduced, but we're getting the negative effect, and that's which typically means that the market sentiment has changed, and that can get a little confusing. So we try to get in there and provide this information out to you as to what's on investors' minds, why they're reacting, why they're reacting to the way they are, and why the rates are moving in certain directions, and give you that information so you can have some useful information while you're following the interest rates. A little bit about myself is I am a loan officer. I work with a national lender. We lend in all 50 states. So if we could be of any service to you, we'd love to earn your business for any refinance or purchase needs. So please reach out. But more than that, we like to be a resource for you folks. So if you guys got questions about anything, we'd love to be here for you guys and answer any questions you guys might have. So without further ado, we'll just jump right into our report. We'll start off here with the economic calendar. And also, my apologies on these videos a little late in the day. We're almost to close. We've got about another roughly hour or 45 minutes until the market closes. So my apologies on getting this out to you guys a little late. But I guess it's better late to be than never, I guess. We'll start. We got caught up on HPIs, which means Home Price Index. We got the first one with the Case-Shiller, which measures the 20 largest metro areas in the U.S. here, month over month. This is for month of April. So March, it rose 2.4%. Forecast is supposed to slow down to 2%, and it came a little bit lighter at 1.8%. Now it's year over year for the month of March. It got revised slightly lower from 21.2% down to 21.1%. Forecast is supposed to show more slowness down to 21%. However, it had a slight uptick, or if it wasn't changed, we would have had unchanged levels at 21.2%. Now we also got the FHFA home prices and these HPI, and what this is, it measures the conforming loan limits products out there. So month over month, it was revised in March from 1.5% to 1.6%, and it came at the same pace for the month of April. However, it's again kind of like it's year over year went from 19 to 19.1 in March, but it dipped. This one shows a little bit of a dip this month in the month of April for at 18.8. Now here's kind of one we want to definitely keep an eye on: consumer confidence. We've been seeing this kind of dropping of late as people are getting kind of fed up with the high prices, the high inflation, gas and food, of course. So back in May, it was at 106.4, which got revised lower to 103.2. Forecast was looking at 100.4, and it came in lower at 98.7. So the concern behind the consumer confidence is that when you have low consumer confidence, people aren't feeling as well. So they're most likely not going to be out shopping or buying or doing different things. And a lot of this, of course, could be attributed towards the high inflation, where they're spending more of their money on gas to get to work and go places, and food for the family, that they may not have that extra to go out and do other things like go out to eat or vacations or entertainment and stuff, or buy different discretionary items out there as well. So this is a concern, because if that happens, that means the economy is going to slow down, which could lead us into recession. There are a few economic people out there already thinking that have voiced that that we could potentially be in a recession as of this period. It was the first quarter GDP we saw that went in negative territory. Will be interesting to see what second quarter will look like. But the concern right now on Wall Street is that, of course, uh, John Williams spoke. He's the Fed for New York. He doesn't think we'll go into recession, but he thinks the economy will slow down with the pace of the rate hikes. He said the Fed is still kind of debating if they're going to go 50 or 75 at the next FOMC this coming month here in July. So again, I think Wall Street's just thinking more negative, that maybe that we may be in the recession, or we most likely will be in a recession because where things are going with the pace of Fed's strict policy to try to bring inflation down, which is definitely needed. However, the economy may not handle it as well as they may think it will. So that's what's on Wall Street's minds, and stocks are down. Today, they did start off earlier today upwards, and that was because China had announced that they loosened up some of the COVID restrictions over there. So that hopefully will bring in some more productivity, bring some more supply to the market. Uh, so that initially started the day off, but as we got further in the day, stocks went into negative territory. We were a little bit deeper, as you can see here with the little wick down there, but have come back a little bit. For the most of the day, I was seeing between 8 and 11 basis points. We were down 8, 11 basis points. Now we're down to, coming close to the end, down 5 basis points. So for the most part, depending on when lenders gave their pricing, we may not be that any really more or less unchanged, but there might be a slight negative connotation or slightly like in pricing. So that you may find in your pricing. So your rate sheet may look like probably not affecting the rate itself, but maybe there might be slightly different pricing on that. That's what we might be looking at on this. Yields, we are still under that it was testing at 320. Now we're down to just under 3.19, which is good news. Hopefully that 320 provides a pretty strong ceiling. But also be prepared. Thursday we do got that PCE report coming out, and when we had that CPI report, that's when we had that really bad market. As you can see here, it was right after here. This is when all this happened after that CPI report, and the PCE actually has a little bit more weight, primarily because it's the Fed's favorite gauge for inflation. So that comes out Thursday, and a lot of people are kind of thinking it may not be so pretty. So just be a little cautious out there. So lastly, let's go ahead and take a look, see what the average rate for conforming loan limits. They do have points built into it, and they are kind of day delayed on these. So brought out there. So a 30-year now, or we'll start with the 15-year, and that's at 5.3%, and the 30-year is now at 5.95. Still slightly under 6%, but we're quickly approaching it. So hopefully, let's see what Thursday transpires. All right, folks. Again, we're here for you guys. If you guys got any questions, if we could be of any assistance to you, we'd love to earn your business. So again, please give us a shout and see what we can do for you guys. We do have a lot of great programs out there, some great ARMS programs, as well as we got some buy downs, 2-1 buy downs for purchase transactions. So you can ask me about those. We just released those, as a matter of fact, today. So if you got questions, if you're out buying and want to try temporarily reduce your rate, go ahead and reach out. That might help you guys out until rates come back down a little bit potentially, and always get back into refinance into a lower rate. All right, folks. Again, if you guys can do us a favor, we greatly appreciate it. If you guys can like and share our videos, it helps us out, our channel, and we greatly appreciate you guys. You guys have a great rest of your day. Thanks so much for watching. We'll see you guys in tomorrow's video. Bye bye.